things that we provide to clients who are in the small business arena, from those individuals up through the business operations, and mostly clients that don't need financial statement audits and things of that nature. We're going to basically break this into two different components. Jeff is going to speak on some core issues about trust and trust taxation, because that's an area that is basically a building block for most of the estate planning and financial planning of many of our clients are engaging in. And then I'm going to basically address a whole potpourri of tax issues that have and observations that have come up as a result of the new tax law and some planning that we see clients undertaking as a result of that. It's a small group. It's intentionally a small group, so we want this to be interactive. Don't hold your questions till the end. If you have a question, an observation, anything that you want to add as we're going through, just please chime in. That's the goal here, is to make this interactive and not just have us be talking heads all morning. With that, welcome everybody, and I'm going to turn over to Jeff to get started on the trust issues, and when you need me to do some technology, I'll do my best for you. So.
Good morning. Thank you for coming out. I appreciate that. The first thing we're going to talk about today is trusts and what they are, what they do, how to use them. We'll give you some examples of how they work and things of that nature. So the first thing is, what is a trust really? It's a legal vehicle that is a separate entity than the owner of the original assets. They hold assets and they dictate how and when the assets and the income generated by those assets will be distributed. Why would that be important? A couple examples that I can give you are, I have a client who, let's say, husband and a second wife. There's kids from the first marriage. The husband wants to give some of his assets once he passes away to his children, but he wants his second wife to enjoy the benefit of the income from those assets and some of the principal perhaps. And so he puts money into a trust for the benefit of the income benefit for the second wife, knowing that when she passes away, the principal that's left over will go to not only the children that he has from the second wife, but also his children from his first marriage. So here's a way for assets to be put into a trust, and the person who creates the trust dictates how the assets are going to be transferred when he passes away. If it were to go directly to the second wife, perhaps she wouldn't include the kids from the first trust, so the first marriage. So here's a way to make sure that his wishes are being taken care of. The trust manages the distribution of the assets by transferring its benefits and its obligations to different people. When the assets go into a trust, the trustee now is responsible to manage the assets, distribute the assets for the wishes of the grantor. Perhaps that the trustee is the same person as the original grantor of the assets, but sometimes it's not. Sometimes it's a bank, sometimes it's a trust company, sometimes it's children. I have a situation where parents are getting older, they can't really handle their financial affairs anymore, so they want the children to take care of their assets. They put money into a trust. Trustees are named for the children because they can take care of the assets and they don't have to manage it anymore. So it's no longer in their responsibility to take care of the assets, so the responsibility is transferred to another party. It can help to create and preserve your legacy after you die. I mentioned before that it gives the wishes for those, the grantor to transfer and do with the income as the trustee is required to do in the trust document, and it can give the grantor the ability to dictate those things after they pass away, like I mentioned before. A certain kind of trust, revocable trust, helps provide privacy by avoiding probate. I'll go a little bit more detail there later, but here's a way to make sure that the assets are in the wishes of the grantor, avoiding the whole court system, and if you pass away, the assets will go right to the beneficiaries as opposed to having to go through probate. It saves costs. We'll go over that a little bit later. So what? Let's see. Okay, so
want me to move it?
No, not at all. Not at all. Okay, so how are trusts used? Trusts are used in many ways. They're used for credit protection. They're used for estate planning. They're used to protect beneficiaries who may be minors or disabled, or those children that have deemed to be bad judgment from the parents. And they're also used to manage unique assets that aren't easily divisible, such as property real estate, commercial real estate, those kind of things. It can hold life insurance, and it provides a vehicle for charitable giving. We see a lot of charitable trusts and things like that, so that the money can go in there, the grantor gets a deduction on their tax returns, and the money gets distributed out over the life of the charitable trust. I'm going to concentrate on things for estate planning, because I think that's applicable for this group here. So when you use a trust, it can supplement or replace even a will. And by doing so, it can avoid probate, as we mentioned before. It also can reduce estate taxes by transferring monies while they're appreciating, and it can be transferred to the children and grandchildren or other heirs with a reduction in the estate tax liabilities. By doing so, by putting money into a trust, the assets that go in there are frozen from the grantor's estate, and all the appreciation then is not taxed at the grantor level. It may be taxed at the beneficiary level once it gets there, but it is a way to reduce the transfer tax at the I'll say parent level. Over time, the assets will grow outside of the estate and not be included in the estate value, and it can be, the beneficiaries would then be the recipient of the appreciated assets. How are trusts created? It's a legal document, so you have to consult with an attorney to be able to create a trust. And in essence, what happens is the assets are transferred into this separate entity, and they now own those assets. And it could be, and you name a trustee, who's going to take care of the assets. Again, it could be a bank, it could be a trust company, it could be yourself, and it could be some other family members. And they manage the assets of those the property included in the trust for the benefit of the beneficiary.
Just to comment on the naming of trustees. Sometimes during the estate planning process, the ability to name certain trustees is prohibited because it could create an issue with the ability of those assets that you placed into that trust to be excluded from your estate upon your death. So, although you can name yourself as a trustee when you're contributing assets, if the purpose of the trust is to provide for an estate planning benefit, to have those assets excluded from your estate, you often are not able to name yourself or others as trustees because of the tax laws that would re-include those assets back because of the level of control that you might have.
So the trusts come into two broad categories. There's testamentary trusts and living trusts. The testamentary trusts are created in your will, and they transfer to the property into your designated assets into the trust. After the death of the grantor. If the assets are part of your estate, then they have to go through probate prior to them going into the trust, and they're generally irrevocable because the grantor is no longer living. The second broad category are living or inter vivos trusts, and they can be created, or they are created during the lifetime of the grantor, and they can often be continue after the death of the grantor. Again, this type of trust will avoid, in certain circumstances, will avoid the probate assets. Living trusts can be irrevocable or revocable. The revocable type they are considered part of the grantor's assets, and they're subject to estate tax. The irrevocable kind permanently relinquish the assets that are transferred into the trust, and the trustee and the grantor no longer has the rights to the assets. There are certain trusts that give the rights of the grantor to make changes, and we'll talk about that in a little bit. Okay.
Jurisdictionally, the probate process in some states is much more complicated and more costly than in other states. So what you often will find is Jeff talked about revocable trusts. So those trusts don't have an estate planning per se, plan to transfer the value of those assets outside of your estate. But in states with high probate costs, very visible probate processes, and very time-consuming probate processes, the trust avoids having those assets go through that probate process. You'll see with all clients that move to Florida. Most of our clients who have become Floridians have restructured their asset ownership into revocable trust ownership to avoid the probate process, which is much more severe in Florida than it is in a state like Pennsylvania.
Okay. Different types of trust. Simple trust. Generally, it's irrevocable with no ability to change the terms of the trust. Can be created during the grantor's life or by will. Required to distribute all the income currently, and does not allow for the distribution of any of the corpus or to make any charitable contributions. The beneficiary receiving the income will pay the tax on that distribution, but the trust itself pays the tax on any of its capital gains. Why would you create a simple trust? Examples that I encounter in my practice is generally after death, the grantor wants to put assets into this trust so that, as I mentioned before, perhaps the second wife will get the benefit of the income, but the assets then get distributed in a different way than the income beneficiary. There's also complex trusts. These are generally also irrevocable, and there's no ability to change the terms of the trust. There's no income distribution requirements, but you can distribute some of the corpus. In these trusts, the trust itself pays the tax. Part of the issue with a complex trust, as far as taxation is concerned, is that the tax brackets are condensed, and so they pay tax at a much higher rate at a lower income level. These I've seen in my practice, at least, they're used for situations where there's a minor child, for example, or maybe there's a disabled child who can't handle, that doesn't need the income, perhaps, or they need it for a later date and time, and so the assets will stay inside the trust. They'll grow inside the trust, but the trust itself will pay the tax.
To the extent that the trust exercises, the trustee exercises their discretionary power under most of these complex trusts to enable them to make a distribution to a beneficiary, then to the extent that a distribution is made, that distribution does carry out income to the extent that there's been distributions made to the beneficiary. But if there's no distributions made and the trust is operating as an accumulation vehicle, it's paying its own tax on its income.
And then the beneficiary is taxed at their level for the income they receive?
If a distribution is made out of the trust, the income of the trust to the extent of the distribution carries out to the beneficiary, and they'll pay tax at their bracket. So there are some, Jeff, I don't know if you were going to talk about tax bracket planning, but you want to.
So there's a choice.
So well, typically the trustee has powers under the trust. If they have the power to make the distributions, then it's going to be the trustee's discretionary capability to do that. Bear in mind, as Jeff just said, the trust tax rates are very compressed. So you're paying tax at the highest level rate on income very quickly. Beneficiaries may not be in the highest bracket. So distributing monies out of a complex trust to a beneficiary could have some significant income tax savings. It may be against the entire concept of what the grantor of the trust planned with these assets. You have to be very careful when you balance what the goals of the trust are against the income tax savings. Don't let you'll hear me say a couple of times, don't let the tax tail wag the dog. The question is what are the long-term goals of the trust and the assets, and what generation they're ultimately going to end up in.
The complex trust is not set up for income tax savings. It's set up for some other reason related to that beneficiary.
Right, with the discretion to provide for income tax planning because of that discretionary power. Exactly.
I've seen in my practice in the complex trust area, education kind of trust, where the grantor wants to put money in there for the benefit of the education for the grandchild, perhaps. And so it accumulates over time, and then when there's a need for it, it's distributed. So there's an example of that. Okay, the third kind of type of trust, is the grantor trust. And this is a living trust that's created while the grantor is alive. And what makes this different than the other kind of trust is that there's a power that they retain over the trust that allows certain things to occur that is not allowed in other kinds of trusts. And they can be revocable or irrevocable. There are certain powers that make a trust a grantor trust, a revisionary interest in either the corpus or the income of the trust. Another power would be the power to substitute assets, or the power of the beneficial enjoyment of the income or the corpus by the grantor. Why would you want to set up something like this? There's a couple of good tax planning techniques that we've come into. Sorry. There's a couple of tax planning techniques that we have seen by the use of grantor trust. Before I go through that, I want to go back to the revocable trust and some things that Scott had mentioned, that it avoids probate and it provides for privacy of the asset distribution. There are many states that have high probate costs. There's also legal costs involved in that. Oftentimes the assets will take longer in a estate area versus in a trust, a revocable trust, to be distributed to the beneficiaries. So for these reasons, you may consider having a revocable trust so that there's a quicker transfer of assets and generally cheaper than in an estate arena. And the cost of the estate transfer could be up to 5 to 10% or so of the estate value, and in the probate and in a revocable trust, it avoids a lot of those costs. Also, some things that I've seen is that out-of-state property, if it has to go through probate, it often it's more complex. You have to go to the probate office of that locality where the property is. Here in the revocable trust arena, it's outside of that issue. Easier to transfer to the beneficiaries. Also, in the revocable trust area, the wishes of the grantor are not made public, and so assets can be transferred in privacy. Another grantor trust that we've seen a lot are grantor retained annuity trusts, otherwise known as GRATs. These are irrevocable trusts where the grantor transfers assets into a trust while retaining the right, again, another key to having it be a grantor, retaining the right to receive fixed annuity payments. There's a prescribed IRS code section 7520 that offers the rates for the annuities. They're usually paid annually, at least annually, and for a specific term. At the end of the term of the GRAT, if there continues to be principal in the trust, it can be transferred to the beneficiaries without having an additional gift tax or transfer tax or state tax issues there. The appreciation in the GRAT, if it's higher than the annuity repayments, goes to the beneficiaries, again, tax-free.
That's typically used if you have maybe a family business or something and you create a valuation on the business and you swap them in.
That's one use of it, yes. Yeah.
It's, that's a very powerful way to use a GRAT, because the beauty of a GRAT is that you're putting in an asset that you anticipate will appreciate over that annuity period that Jeff talked about.
You bifurcate the ownership into voting, non-voting, you get a depreciated value, and then you can run the money back, and then the value of the company.
So you're getting much more complex with the. But before you get to that, I think the point is to understand the power of the GRAT and then how to utilize it. So the power is to step back from something that Jeff said. The beauty of a grantor trust is that for income tax purposes, a grantor trust is a non-tax paying entity. The grantor, the person that Jeff spoke about, that retains the power to get the principal back, who retains that power to substitute property, pays the income tax on that trust.
So then the principal gets to appreciate tax-free.
Well, right, because in effect, the grantor of the trust is coming out of pocket from their other assets to pay the income tax generated from that trust. So the trust itself can continue to accumulate its assets without a tax burden. One caveat, Pennsylvania does not recognize
Right.
grantor trust, so in Pennsylvania, the trust is taxed as though it was either a simple or a complex trust, under the same rules that Jeff talked about earlier.
The other benefit of the grantor paying the income tax is that it's another transfer down to the next generation. Right.
Free of gift tax.
Free of gift tax, yeah.
So to go back to your example, you know, we have clients that use the grant process. Let's go back into your role as investment advisors. You have Apple stock in a portfolio that you
Hold on,
anticipate.
hold on.
You're going to do this?
Yeah, hold on.
Then I'm not going to talk.
Hold on.
Appreciation grows.
Yeah. Part of the things you need to consider in this type of trust is, are you willing to give away the appreciation of the assets after it's over? Some people need the appreciation, want the appreciation, but if you're willing to give it away, then this is a good tool for you. Again, the federal income taxes are paid by the grantor, which is another way to gift out money, free of gift tax implications or state tax implications. Let's see, what did you say here? Okay, so what I've seen in my practice is what's called a zero-out grant, and it's an investment, it's a bundle of assets that are contributed to a trust, a grantor retained annuity trust, and the annuity payments equal the value of, the present value of the assets that are transferred, so that over time, the grantor is receiving back the same amount that it transferred in, so there's no gift tax implications. And so, can I use the board now?
Oh, sure.
Yeah.
I'm now the technology person.
Yeah. So I want to give you an example that Scott was starting to allude to.
There you go.
And so what I've seen in my practice is that a shorter term, a couple of years, maybe 3 years of these grants. One of the issues is that if a grantor dies in the middle of the term of a grant, the money goes back to the grantor and you kind of lose some of the benefit of this. So usually I've seen it in the short term. And the essence is that the expectation of the assets are that they're going to appreciate faster than the IRS code that requires return of the money. And so in an example, the initial contribution is $1 million.
There you go.
There we go.
$1 million.
Color of money.
Okay. In the first year, we're going to say there's growth of 8%. Okay, at 8%. So the assets now grow $80,000. And the value before the first year of the return annuity payment is $1,080,000. Okay. In the first year, and just take my word for this, but the assumption is that the return has to be 3% annuity repayment. Would be, this is the first year of the annuity, would be $530,000, half of the original contribution, and then 3% of the original contribution, $530,000. This is a simple example. So the remaining assets at the end of the first year are $550,000. Okay. In year 2, we're going to say 8% growth again. So that's another $44,000. So at the end of the year 2, before it's over and before the final annuity payment, you have $594,000. Okay. Again, the formula for the annuity payment is half of the original plus 3%. So it's $500,000 plus $15,000 because now the remaining assets in year 2 is $500,000. So at the end of the term of the grant, the remaining value of the assets is $79,000. Okay, that's the assets that can be transferred to a beneficiary without having additional tax or gift implication. So when these work, they're very powerful. And what I've seen in my practice, and tell me what you've seen, is they're rolling, meaning that in year 1, there'll be a contribution of, say, $1 million, I'm using a number. In year 2, because you're still in the middle of the grant period, there'll be another $1 million. Then when the first grant is over, it's year 2, then another $1 million goes in because the grantor now has received another $1 million back, either in stock, cash, or some other method. So they keep rolling over, so that at the end of the term, you're continuing to distribute a certain dollar amount to the beneficiary without any tax implication.
You move forward, let me bring this down.
Oh, yeah, board's over, thank you.
Okay.
Any questions on that?
The power of this is that when the donor put that $1 million of stock in, and because they had this retained annuity that they were getting back, the net value of that contribution to the trust was zero. So they did not make a gift, a portable gift to any of their beneficiaries. So at the end of the term, in an appreciating market, you win because you've now passed, in this example, $79,000 of wealth to the next generation, free and clear of any gift tax concerns or estate tax concerns. I don't know if this, did I get it?
Right, but you can't do this in Pennsylvania.
Grat?
Yeah.
Sure you can.
You can, but the taxes are paid, the Pennsylvania taxes are paid by the, state taxes are paid by the federal government.
Right.
And being that it's 3% in Pennsylvania, it's not an onerous situation.
And,
Higher income.
and again, because this is a GRAT, which means it's a grantor trust, the income generated from the stock each year, if it's a dividend, for instance, the tax on that is also being paid by the grantor, not by the trust, other than in Pennsylvania, which is an anomalous state. I believe it's the only state in the nation that doesn't recognize grantor trust funds. So it does cause some planning headaches when we're using these techniques. So to back to Paul's point, which is if you take this and you put it on steroids, and you take an asset in a private company that you've been able to value because of a minority interest of that company that you're transferring into this GRAT. And the expectation is that because of that discount, that there will be immediate appreciation plus much higher growth. You get a very powerful result. So we had a client who created many of the GRATs that we see for planning purposes are these 2-year GRATs that continue to roll. The IRS is not happy with 2-year GRATs. They think they're too short in term, and Congress has talked over the years about requiring them to be much longer term to take away some of this power. But we had a client put private equity in his company into a 5-year GRAT, deeply discounted value for the stock, and we don't do the valuation. It's done by a third-party valuation company. Gift tax returns are filed showing that the gift to the GRAT was made with virtually no value, zero. Some attorneys we work with insist that the GRAT has a value of a modest amount, so that when you report the transfer into the GRAT on a gift tax return, you're starting the statute of limitations on the IRS being able to assess the gift. So it's not something that they can look at many years in the future. In their case, the company during that 5-year period grew so significantly that it was able to fulfill that obligation each year, the annuity, out of its own cash flow operations. So at the end of the 5 years, when the GRAT ended, 100% of the securities that the client had put into the GRAT remained in place for the benefit of his next generation. And it was, that would be your home run or grand slam. I think the real answer to that, Paul, is they had an extremely aggressive valuation done when the gift was made into the GRAT, and that's what caused
But it works
the result.
well if the company's able to dividend out enough cash to throw into the GRAT that enables the GRAT to then repay the annuity without having to touch the corpus.
It's very rare that there's enough income generated in a GRAT from the asset to allow the income to fulfill the annuity payment. Because as you can see from this example here, over 2 years, this GRAT had to return almost $1,060,000 back to the grantor. You need to have a lot of income generated from that to preserve that $1 million value at the end of the 2 years.
Extra cash flow.
Extra cash.
Yeah.
And is it always the income, or so if you put stock of a company, and it doesn't generate enough income?
You distribute the stock back.
That's what I was saying, so it's
Yeah.
not just always income, they could be getting the stock
Well,
back.
if you put Apple stock in, at the end of year one, that $30,000 distribution is going to be predominantly shares of Apple equal to that 530. Especially if it's like a non-dividend paying stock, then there is no cash flow generated from it, so it's purely market value driven distribution. They're very powerful tools, and again, they're really powerful when you have clients who are paying estate tax, who are in an estate tax world where they want to transfer wealth to next generations and avoid increasing their estate by the appreciation of these assets.
Which is changing because of the increases in
Exactly.
the exemptions and the portability issue.
Does the required annuity payment always have to include a return of the principal? Like in this example here, you gave all the principal back plus 83%.
The annuity requires, in order to get that, in order to zero out the GRAT, to make the GRAT a non-gift, to make it a non-gift, the annuity has to basically be of a magnitude that on the present value is equal to what you put in.
And that's all in the document.
And that's on the, yes, it's on the document. And at the end of the term of the GRAT can determine how that $79,000 remaining gets distributed to the next generation. Some of our clients have these rolling GRATs at the end of each 2-year term. Whatever's left over in the GRAT goes outright to his 3 grown children. In others, the assets stay in trust for future generations or multiple future generations. And some of the GRATs are designed to continue to be grantor trusts after the GRAT term ends, so that the power is that the asset, whatever's left, that $79,000, can continue to accumulate income tax-free, and the original grantor continues to pay the tax on whatever income is generated from that asset. So, a lot of powerful tools with this.
There's a lot of upsides, and the downsides really are just the cost of administering, because if it doesn't appreciate, then you just get back to the original investment without any other gift or tax, state tax implications. Okay, advantages and disadvantages. So some of the great advantages are some of these trusts is that you remove your assets from your estate, and if they're appreciating, then all the appreciation goes down to the next generation. Gift and tax, estate tax free. Again, with the increases in the exemption rates, that not everybody is running to them as much as they used to be, because that's 22 million and change, and it's growing at the current administration.
For married
couples, right? And so, if your estate is below that, you may want to hold on to your assets now and let them appreciate, and you get to step up at your death. If your assets are more than that, then you may want to consider that so that the further appreciation is outside of your estate. Another advantage is you get to control the assets at the end of the term of or during the term and at the end of the term of the trust. Like I mentioned before, if you want to transfer the assets differently than what the direct gift person may want to do, then you can put the assets into a trust so that the beneficiaries are named in the trust and it can't be changed. Protection from life cycle events. So that includes things like a divorce, for example. If you're divorced and you want your assets to go differently than you otherwise may, you want to put assets into a trust. It also avoids probate. So some of the benefits of a trust, a revocable trust, is it avoids the probate process. We mentioned that before. Another advantage would be that it shifts the burden of managing the assets to the trustee. An example I mentioned before, if you have an older couple that can no longer handle it, someone who's disabled, yourself, including yourself or your children, it pushes the burden of the management of the assets to a trustee. What are some disadvantages? In a situation where you're transferring assets into a trust, you may no longer have control of those assets. The use of them, the income, how they're transferred to beneficiaries, etc. So you need to be careful that if you're putting money into a trust, that you have enough assets otherwise to be able to live on, etc. They also are more costly. There's returns to be filed. There's lawyer fees to be paid in order to set it up. There could be trustee fees, things like that. And as we discussed before, there could be potentially higher income tax implications in a complex trust area where the rates are condensed.
Do you have any comments on what assets don't work? I mean, we understand the benefit of assets that have the potential of, appreciation, but are there, just from either one of your experiences, any assets you say, you know what, those are ones that you really don't want?
Well, it depends on what the trust is being created for and what the long-term goal is with respect to the trust. So, depreciating assets are bad assets in a grant because if your market goes down, the grant fails, and you end up with the assets back, and you incur the cost of setting it up, administering it, and filing tax returns. It's not a big cost comparative to what the upside is. I'm not sure what other assets themselves may be problematic in a trust, although you have to be very careful with assets like stock in a subchapter S corporation, which is a different topic entirely, but not all trusts are eligible shareholders in a subchapter S corporation, so there are certain types of equities that if you put it in, you could run the risk of creating a major issue for that entity and its ongoing continuation of its status at sea.
Any questions? Besides that?
We tried to, this was a half hour sort of about trust. What takeaway on some of all this is that you should be aware trusts are extremely flexible vehicles. The design of how they operate, who they benefit, how they're intended to benefit them are the nature of the document that's drafted. So it's really important in creating these that you, your clients, and everyone are forward thinking, and you're looking at not just what you're trying to achieve today, but what the ramifications of what you're trying to achieve today may occur 1 year, 5 years, or decades and generations down the line. And one of the biggest struggles our clients have now that trusts are allowed to basically last perpetually. In the old days, trusts had to terminate at a certain period of time. It was a legal rule called the rule against perpetuities. Under many state laws now, trusts are able to, there is no rule against perpetuities, so trusts can last forever, virtually. It challenges clients who, when they set up a trust today and they know that their spouse or their sibling is going to act as the trustee because they have trust and faith that that person will fulfill their role. What happens as generations go on as to who's going to be the trustee? Some clients are very comfortable with corporate trustees, trust companies, banks to act that way, and that should preserve the ability for perpetuity. Banks never fail, right? But but in general, that creates that comfort. But if some clients don't want an institutional trustee, and they struggle with how you set up a future passage of trustee powers to future generations, and all this has to be thought out and considered as these are done. And every trust has a unique purpose, so they will have different terms, different provisions, and will be drafted in ways to achieve what the goals are that the client's trying to do. Any comments, questions, or anything about that we'll talk about before we move on to a whole different set of topics? No? Okay. So I'm going to tackle basically just a bunch of observations and topics that have come up as a result of predominantly the new tax law, and sort of now that we've gone through half of the tax filing season at this point, since almost half of our client base went on extension this year as a result of some of the complexities of this new law, what we found so far. So the first thing, which is I'm going to talk about, is the topic that got the most press when the new tax law was enacted, and that was the elimination of the benefit of deductions of state and local income taxes and real estate taxes that most individual taxpayers and trust taxpayers enjoy under the prior law. So there was an unlimited ability to deduct state and local income taxes, real estate taxes on tax returns prior to the new tax law. The new law imposed an aggregate limitation which does not allow you to deduct more than $10,000 in total for this bucket of deductions. So when you think about it, who did it impact the most? It impacted those individuals living in states where there was high real estate taxes, high state and local income taxes. If you draw a map using the red and blue coloration, which many of us now see every night if you tune into any of the cable networks, the states most affected by this were individuals living in California, New York, Connecticut, New Jersey. As you can see, the political leanings of all of those states, there was an outcry by those states that they were being singled out because of their politics as opposed to whether this made valid tax sense. So they're basically all the blue states. Many of them have sued, challenging the new law saying it discriminates them. Nothing has gone through yet in any way that's been positive for them at this point in time, and I suspect that we're not going to win on this, but we shall see. One of the fallacies in the dialogue on this that turned out to be the case was that many of the individuals and clients that we had living in these high income tax states never really benefited from their deductions for state, local, and real estate taxes in the past. There was always, and there still continues to be, a parallel tax system in our country called the alternative minimum tax, where every taxpayer is supposed to compare what their tax liability is under normal tax provisions and compare that to the tax cost under this parallel alternate system. And the alternate system is very simply basically a flat tax. It's a tax that where you take your taxable income that you compute for regular purposes and you start adding back a whole bunch of the deductions. So you start eliminating the benefit of those deductions and creating, as you can tell, a much higher number, and a lower tax rate is applied against that higher number. And you compare the two, and whichever of your two tax rates is higher, that's what you pay. State and local taxes and real estate taxes were one of those items that were required to be added back under the old alternative minimum tax and the law. So many of our clients that were in these states were losing the benefit of these deductions in any event in the past because they were paying the alternative tax every year on their tax returns as opposed to their regular tax. This particularly hit high net worth taxpayers who were not generating, the bulk of their income was no longer being generated from ordinary income, wages or income passing through from their businesses, but clients who have sold their businesses and exited, and the bulk of their income generating assets were in the form of investment portfolios, hedge funds, private equity type investments. So more capital in nature generated income. Those clients were often paying high state and local taxes on their income, paying high real estate taxes because many of them had multiple residences. And on top of that, under the old law, they were able to deduct all of the investment fees that they paid to all of you for serving them and providing this. That also was an eliminated deduction under the new tax law. So just this outcry, it affects this new law affected high income earners who are still working, people like us who make a living from working and get wages or business income, and those living in all those states I mentioned who were generating a lot of ordinary income.
I just add to that one
Sure.
thing. It also included the tax prep fees. So we were also viewed as a deduction that was lost.
Yes.
Just to add that.
So what happened was a bunch of states started to say, how do we work around this new law and provide our residents with the ability to get a benefit? And they came up with an ingenious idea, although it's an idea that has been used for a long time in other states for other purposes. But the ingenious idea was states like New Jersey passed laws that said, we're going to make income taxes, real estate tax type payments voluntary. And we're going to allow our residents to, in lieu of paying them, make a contribution to a new community charitable organization. And to the extent they choose to make that contribution into that organization, we're going to give them a credit for the taxes they would otherwise owe. So, very simple. I owe $10,000 in real estate taxes, and in lieu of paying my $10,000 to my municipality, I make a $10,000 charitable contribution to a community fund that's going to use those dollars, by the way, to give the municipality the money they need to perform their services. But I no longer have made a tax payment. I made a charitable donation. Charitable donations are still allowed under the tax law. So I've converted what is otherwise an income tax deduction into a charitable deduction and created a deductible benefit. These types of things are not new. Rachel is very familiar with them. Pennsylvania has always had for many years now an educational income tax credit process where individuals and companies can put money, make a charitable contribution to an organization that's going to use money for educational purposes, and Pennsylvania gives that donor to that charitable organization a credit against their Pennsylvania income tax of up to 90% of their contribution. So we had many clients, many people do this because they're charitably inclined and they want to support these organizations, but at the same time, there was a great income tax ploy under the old law because, as I said, many of our clients paid alternative minimum tax, so they weren't really getting a benefit from these state and local taxes anyway, so they were able to convert their deductions for taxes into charitable deductions and get the best of all worlds. A 90% credit from Pennsylvania and a full deduction for the full amount they put into this charitable organization.
So they got back more.
They got back. They actually made money on this.
And the financial advisor came up with that idea, right?
Well, it was actually a Pennsylvania legislators. It was a backdoor voucher system to enable, because the monies that you put into these programs are being able to fund scholarships for private schools throughout the Commonwealth. The Archdiocese was a huge promoter of this because the largest private school system in the state is the parochial schools, and they were able to benefit dramatically from this. The Jewish day schools have millions of dollars that funnel through this, and it served a great purpose in doing this. The IRS always turned a blind eye to this for years because they never thought about the AMT, the alternative minimum tax consequence. So they always just said, well, all someone's doing is taking a deduction from the tax bucket into the charitable bucket. They're both deductible. No harm, no foul to us as from the government side, so let them go. Everything changed when several states passed legislation after the new tax law to modify, to try to circumvent the new law. And the IRS last year, I believe it was in August of last year, end of July, August, issued a set of proposed regulations, which have now been put into final form in the last couple of weeks. And the IRS said, wait a minute, you can't do this. And they said, not only can't you do this for what the states are doing now just to try to circumvent the new law, this doesn't work for anyone. So the new rules apply to all of these programs, including the ones that pre-existed. And the IRS took the approach very simply. Think about it. If you give $10,000 to a charity, and the charity turns around and gives you back, this is not a tax issue, just in general. You go and give $10,000 to a charity, and in return for that $10,000, the charity actually gives you back something of value. You get back $5,000 worth of meals from the charity for attending their gala. You get back, you give us $10,000 and you're going to get back a lifetime supply of mugs, of things of that nature. The tax laws for charitable giving always said if you get a quid pro quo, you're getting something back in return for your charitable gift. You can't deduct the gift to the extent of what that value of that gift was. So it's the one that most clients tried to always take advantage of. They would go to a silent auction that a charity was running, and they would bid $1,000 for that weekend, that special weekend in Tuscany, and say, oh, I can now take a $1,000 charitable deduction. The law's always been no. The value of that week in Tuscany has to be offset against the gift that you give. The IRS said this is no different. These new rules from that quid pro quo analysis. You've given the money and you're getting something in return. You're getting back a tax credit that's valuable. That's equal to, in Pennsylvania's case, 90% of what you put in. So you have to reduce your deduction by that benefit. It went through, after the proposed regs went out, there was an outcry, as you would imagine, from the states that passed the laws, as well as people from all the other states that had these plans that had been implemented and in place for totally other purposes, nothing to do with this issue. And the IRS came out and very clearly finalized the regulations following almost precisely what they proposed last year. So I raise this because I think it's really important. There were actually time deadlines in the proposed regulations that gifts that were made prior to the effective date last August still qualified for the 100% deduction, and those gifts made after that date. We had a lot of, we had a handful of clients who had to rush to satisfy contributions by that August date last year to get their money into the programs, which was very difficult because Pennsylvania in particular has a very formatted process on how you apply for the credits, get approval for the credits, when you have to contribute for the credits. So I know in Rachel's organization they went through a fire drill last year in August, working through with their donor clients to get money in timely for them to continue to benefit from the deduction and to get the money into the program. I have an example in the outline. I think I've already talked about it enough. There is a couple of caveats to all this. These limitations don't apply to entity level taxes that are paid on their income. So entities that still have required to pay income taxes on their income get to deduct them as trade or business expenses against their income. It's really affecting mostly the individuals and trusts that are paying these taxes because of investment and other types of earned income. Any questions? I'm going to move on to next time. I talked about the alternative minimum tax before, and the one thing that was very beneficial in the new law from an AMT perspective was all these deductions that used to be added back and causing clients to pay alternative tax, most of them were eliminated in the new law. So we're seeing very few of our clients now subject to alternative minimum tax. The alternative minimum tax used to have an exemption amount that would be able to reduce the number. It was like a standard deduction when you think about regular taxes. That deduction phased out based on the magnitude of the income that an individual had. Under the new law, that phase out now doesn't occur until the income is at a much higher level, over $1 million. In the past, it was at a much lower threshold. So not only are these add backs not coming back in, but at the same time, the deduction amount stays fairly robust for a long period of time. So we're seeing, we saw so far through this point in time this year, far fewer clients in the alternative minimum tax. So it changes planning when you're starting to do income tax planning with clients, because now you're looking at back to ordinary income tax rates versus the alternative minimum tax rates as to how deductions and other planning creates benefits. The other big benefit we saw was, I'm only just going to say this in passing because it gets a little complicated. Under the old law, if you paid alternative minimum tax and the reason you paid it was attributable to certain types of adjustments, typically business type adjustments, not the ones I mentioned before, not the state taxes, not the investment fees. Those types of adjustments are often adjustments that reverse over time. Think of depreciation, that if you have a lot of depreciation in one year and a lot less in another year, it reverses. For AMT purposes, if you pay tax because of those adjustments and they reverse, you are eligible to get a credit in future years. Because now so many of our clients immediately went out of the alternative minimum tax, those that had been accumulating credits in prior years suddenly freed up these credits in their tax returns this year. So we had some very pleasant, pleasant surprises when you did the comparison and saw the magnitude of some credits that got freed up. And these are actual credits, dollar for dollar reductions of tax. So it was a pretty robust benefit that a handful of our clients got. Any questions? Okay. So one of the big sleepers when the new tax law was passed, which has now become much more, hopefully you're aware of this, but it's become something of a much greater topic, was a provision that was added to encourage investments in distressed economic zones around the country. And a provision was passed called, with the phrase qualified opportunity zones. And the law created a two-pronged potential significant tax benefit for individuals seeking to invest dollars into these economically distressed zones. The first prong was, suppose you go back to Paul's example. Suppose you just sold your private company at a significant gain, and this capital gain would be subject to tax. The new law allows you to defer the payment of that tax if you invest that gain into a vehicle that's investing in these qualified opportunity zones. It's a deferral. It's very important. I want you to understand that. It's not an elimination of paying tax on that gain. It's a deferral of paying tax on that gain. And that deferral goes out to the year 2026, I believe.
7 years.
It's a 7-year deferral. So at the end of that 7-year period, assuming that you did this in 2018, at the end of that 7 years, the end of 2025, that gain springs back to life. And you'll pay income tax on that gain at that time, at the rates then in effect, which, if you know what that is, I'll know how to do my investments. But you know, assuming that rates don't change, basically you've gotten a significant time value of money benefit by deferring the payment of that gain and the ability to invest it in full, using basically pre-tax dollars. The other benefit, the other deferral aspect benefit is, if you maintain your investment in this zone for that 7-year period, and I'm not going to get to the big benefit of these things yet, you're actually allowed to reduce your gain by 15%, up to 15%. So in effect, not only can you defer that gain, you'll only pay tax when it springs back to life at 85% of that gain. So that's benefit number one. Benefit number two is the real kicker, and that is that money that you've now invested in this qualified zone. If you hold on to that investment for a 10-year period, at the end of the 10 years, if that investment has appreciated, you pay no federal income tax on that gain. So think about this. You have the ability to defer tax on a gain that you incurred today for up to 7 years, and possibly getting a 15% reduction of that gain. And on top of that, you get a 0% income tax the growth of this. The rules are extremely complex. This is not a qualified opportunity zone seminar today. So they're very complex because the rules dictate what qualifies as a valid investment in the zone, what has to happen during that period of time with respect to the operations of that entity. It talks, the law talks about what gains are eligible to be deferred. Not all gains are eligible for this provision. There's all these holding periods I talked about, how they come into play. And again, it's something that you all need to be sensitive of, because I don't know if your clients are talking to you about that, but we've had a lot more clients now speaking to us about this, and we've already seen some investment firms creating investment vehicles that are pooled funds that are being used to make investments into these zones. The zones are themselves all defined. The governors of every state were required to delineate the zones that met the underlying standards that were set forth in the legislation. Every governor did that last year. Interestingly, what we found is that many of these zones are based on the 2010 census. So Philadelphia, for instance, has turned out to be a fairly good jurisdiction for investment opportunities, because many of the zones are already in gentrifying areas. So keep in mind, the bottom line of this thing is it's not going to work very well if you're investing money into such an economically distressed area that you're going to lose your investment. So you have to look at the economics really critically. Philadelphia, though, if you look at the zones, they encompass areas that you'd say, I'm not so sure these are really economically distressed at this point in time. West Philadelphia part of West Philadelphia is a big zone. If you head north of Girard Avenue into Brewery Town and Francisville areas and up towards Temple area, these are all areas that have been undergoing some massive gentrification in the past 5 to 10 years. So there's going to be a lot of opportunities in the Philadelphia area. I was talking to an attorney in Chicago who is involved in this area and said that they have seen very little appetite in Chicago. The reason is that most of the zones were in areas that you wouldn't want to build a shack to work in there. They're truly depressed areas that they don't see any appreciation opportunities over the next decade. So it's going to be very interesting to see what happens. You had a question, Paul?
Yeah, I have a question. I've seen this mostly in the property area, but to what extent could you, say, locate an operating business and leverage the location of and the value of that business in an operating opportunity?
Good question. The law does not limit the ability, specifically the type of business activity in the zone.
Okay.
Real estate is the easiest to use because it's there. There's no question about the real estate, where it's located, and what's happening. All of its revenue, its rents, its whatever's happening is all happening in the zone, and it will meet all of these tests that are established. Operating businesses are available and qualified for zone status. So if a new business is created and formed in the zone and operates in the zone and it appreciates in value, then you can get the benefit. But there's a lot of bells and whistles that you have to jump through to make sure that the operations qualify as zone operations.
You got to check the box.
You got to check a lot of boxes and go through a lot of due diligence before you go into the operating entity area to determine whether it's going to qualify or not.
Thank you.
Just a couple of things. Again, I'm a big believer in not letting the tax tail wag the dog. So real estate, for people who have been in the real estate business prior to this law, they always had a way to basically achieve this same result with even a better approach, and that was there's a provision called 1031 in the code. I'm not a code guy number here today, but it was a provision that allowed real estate to be instead of selling real estate, you could swap it for new real estate. It's called a like-kind exchange. People in the real estate business often, and when you do these like-kind exchanges, it allows you to, you never had to pay tax on the gain as you swap your property serially over a period of time until you sold ultimately the last property that you swapped for, which could be, for many real estate developers and operators, could be millennia. These things stayed forever. So under the old regime, you could continue to defer your gains. There was no springing gain in 7 years. You just continue to defer it. And the beauty of holding these things, real estate for forever, is if you hold it till you die. Under our death tax regime, the basis of that asset that you own when you die gets revalued to its fair market value. So at that point, because it gets revalued, the basis gets stepped up. You get to sell it at no gain. So in consequence, you've done better than a QOZ investment because you've never paid tax as you've swapped for your properties, and ultimately you pay zero tax when you sell the last piece of real estate in the or real estate entities left in your portfolio at the end. So what we're seeing is the QOZs being used by those who are not in the real estate business, who are having gains from portfolio gains, from selling business entities, and because they don't have the availability to do this. The last item is on this is that there is another tax benefit outside the QOZ area, the qualified zone area, that also provides a similar benefit, and that is there's a provision that allows you to invest in startup companies, small business stock, that if you hold it for a period of, I think, 5 years or more, the gain on that stock is taxed at zero rate. So there are other provisions in the code that give you investment opportunities, that give you the end game of elimination of tax. Any questions on the QOZ? Yeah.
Is it deferred for 7 years or a harder date of 2026?
No, it's a hard date.
Okay.
It's the latter of. So when the law was passed for 2018, the 7 years coincides.
Gotcha.
So if you do a QOZ investment in 2021, you don't get a 7-year deferral on that gain. It's gonna spring back to life in that date. And you don't get the 15. You won't necessarily get the whole 15% benefit either, because that 15% benefit only applies if you're invested in that new zone for 6 or 7 years. If it's 5 years, you get I think a 10% benefit. Before that, zero. So it's a complicated provision. There's been multiple regulations, proposed regulations, and guidance issued by the service. The reason that you didn't see a lot of these investment opportunities at the end of 2018 through the end of last year was because nobody was really sure how to structure them yet, because there was not enough guidance on how the law was going to work. And there's all kinds of complicated rules on partnership interests and how they're going to work and how income's going to be allocated during the 10-year period. But leave it to say, if your clients are asking about them, it's something that it should be in the bucket of things that they might be able to look at. And as I said, I know some investment firms are already starting to roll out investment entities to allow clients to put some of their gains realized. And we've had a couple of clients who had gains in 18 that made investments in the QOZ zones in 19 and were able to relate that back. And so we've reported deferred gain on their tax returns at this point. The state and trust. Be mindful of our time here. So Jeff spoke about this a bit before, and it's very important. The new tax law increased your lifetime exemption from gift and estate tax from what was around $5 million under the old law that had been indexed for inflation to now an exemption amount of $11,400,000 per individual. So with proper planning, a married couple has $22.8 million of assets that will be able to pass free of estate tax under the current law. This also sunsets. As most of the provisions that I spoke about today with respect to the state and local tax deductions, with respect to all the other things, in 2026, everything springs back to the old world for many of these cases, including tax rates. So it's very important for clients that are going to be estate taxpayers. So, families with high net worth families over this $23 million threshold, that they look now as to whether they should start doing some planning to transfer some of the value of these assets and use up their ability to give this amount away free and clear of gift tax before the law may sunset. There was concern when the law was passed that the way it was technically drafted, that it was possible when the provision sunset, that if you made gifts during this interim period of time, that they would be what's called clawed back. They would actually be added back to your state, so you would get no benefit of having given away money in excess of what the exemption was. But the IRS announced that there will be no clawback under the law when the sunset occurs. If it ever occurs, we'll see what Congress does over the next number of years. It will be very dependent on the next election and the makeup of both the White House and Congress. But because of this, most Americans are not going to be subject to estate tax over this next period of time. And so traditionally, the types of planning you do about getting assets out of people's estates may not be the best approach today when you look at their overall picture. Income tax planning may be more important. Think about I was using an example earlier about with the real estate and the 1031 exchanges. If you own Apple stock and you paid $100 for it, and it's now worth $1,000, and you die today, for income tax purposes, that Apple stock is revalued to that $1,000 value. So it means that your heirs now get the stock with a basis of $1,000 and can sell it and pay no tax. Had you sold it for the $1,000, you would have had a $900 tax. If you give that stock to your child or to a grandchild, you may have made a gift of $1,000, but under the current tax laws and the tax laws that they've always been constituted, the basis of that Apple stock stayed at $100 to the donee, to the recipient. So the result is that that person, when they turn around and sell the stock, they would be subject to income tax. So you have to be very careful now when you have people who are not going to pay estate tax, that if they're going to be giving things away, you don't want to give away necessarily the highly appreciated asset that you have. You may want to use something that's less appreciated or has no appreciation, because you're maybe better off holding that asset until you die, avoiding any estate tax because you're going to be under the threshold, and then it passes to your heirs at that higher basis number, and there's no income tax consequence as a result. We are actually seeing some planning opportunities here. So let's go back to my Apple stock example. Why not gift the stock to an elderly parent who does not have an estate tax liability? And now you've given them the Apple stock, and their dad's 90 and you're 50. Am I close? 40. You give the Apple stock to Dad. Dad now holds the stock. When Dad passes, that stock now gets reset. And if you're Dad's only child and you're guaranteed to get it back, that's a big in quotes. You're relying on Dad to give it back to you ultimately through his estate. That stock comes back to you now, stepped up to $1,000. You can turn around and sell it free and clear of any income tax.
Is there a provision that restricts that, a deathbed?
Well, you have to be careful with deathbed gifts always, because they can.
Because they can.
Yeah, but in terms of planning now, if you have a healthy elderly parent and you don't need that asset, you don't need that revenue, The old planning was never to give assets upstream to the older generation. There may be planning opportunities here to use this as a limit. But you got to be very careful, because if you have siblings and there's family dissension, you don't want to give away control of that asset.
Or
You gotta
dad
gift it.
gets married.
What if that
In the
gets
senior
married?
living, right?
No, your point's exactly right. There's risk.
Right.
There's risk in anything you do.
And there's lots of casinos around too.
Jeff talked before about what makes a grantor trust a grantor trust. One of the key provisions often used to create a trust to make sure it qualifies as a grantor trust, which means that, remember, a grantor trust is the income's taxed to the grantor, and in estate planning, grantor trusts can be very powerful because you can put assets into a grantor trust, and if structured correctly, that asset will be out of your estate, but for estate tax purposes, but for income tax purposes, it continues to be your liability to pay tax. So you get to have your cake and eat it too. Get the asset out, and you continue to diminish and deplete your estate by paying tax on assets that are no longer yours. So it's a great win. The provision that's very often used in these trusts to create this status is a swap power that enables you to take an asset of equal value that you own, give it to the trust, and have the trust return to you another asset of equal value. So the fact that you have this power under the tax law creates a grantor status for this trust. Think about the power of what I was talking about giving a stock to your to the next generation up. What if you've put an asset into your grantor trust that has a very low income tax basis? Because you put it in there during a time when the exemption rates were lower and the goal was to get this out. You weren't doing income tax planning with it. And now you own, I'll keep with investment assets. The trust owns this Apple stock worth $1,000 with a $100 basis. And you own a $1,000 bond that you paid $1,000 for. What happens, wouldn't it be a good idea, and you're now 90 years old, wouldn't it be a good idea for you to take that bond and swap it with the trust and take back that Apple stock, so that if you're not going to be an estate tax payer, you now have the ability to have this Apple stock get re-stepped up to that $1,000 value when you pass, and can move on to the next generation free and clear of income tax. So utilizing these swap powers in these grantor trusts is something that we are also started to have some conversations with, and the estate planning bar is doing a lot of discussion about this through on the legal community about utilizing these swap powers. The last thing which we've alluded to on this is trust tax rates are very compressed. So this was the point we were talking to Rachel earlier about, where you have trusts that have discretionary powers to distribute income. You should, from an income tax point of view, you can plan to distribute income out to beneficiaries to get that income into a lower tax bracket. But again, always be aware of what the purpose of the trust was and whether it's really a goal to get this money into the hands of that person who you may not want them to have the asset or the income. Any questions on these items? I have this whole potpourri is just designed. I'm monitoring time, and I want to be aware of everyone's. I think I've got another 10 minutes or so before we're going to break. So, charitable planning. The new tax law did not modify significantly the ability to make charitable contributions. So charitable planning remains and continues to be a really effective tool for those philanthropically minded clients who want to use their wealth to benefit organizations providing services and like to others in our community. There are some issues at the new tax law, some issues that are created in the new tax law that need to be dealt with. The first is Because all of these itemized deductions that I spoke about, state and local taxes and the deductions for investment fees and tax preparation fees were all eliminated. The new law also increased the standard deduction that taxpayers are allowed for married couples up to $24,000. So you need to compare what your itemized numbers are against what the standard is, and you're eligible to take the higher deduction. The only real deductions left on the tax return now of consequence are $10,000 for state and local taxes. That's the max. Most of our clients, between their real estate taxes and what they're paying in state and local tax, exceed that threshold. Mortgage interest, if you have a mortgage on your home, the new tax law did modify mortgage interest deductions. You're under the new law for new acquisitions of homes, you're limited to taking a deduction for interest on the first $750,000 of mortgage. Above that, you don't get it. Old mortgages that were eligible for a higher amount under the old law are grandfathered, so that interest on those continue to be deductible. Charitable contributions are still deductible, and the only other one is medical. So, medical is, we see medical for those clients that are have significant medical issues, because you have to overcome a pretty high threshold to get medical expense deducted on the return. So charitable planning is really important and can be a big component. But if you have a client that doesn't have a mortgage on their home, and assume they give annually $10,000 to charity, they're going to get a $10,000 deduction for state taxes, a $10,000 charitable deduction. That number's 20. That's lower than the $24,000 standard deduction they get. So they're really not getting an income tax benefit from the charitable giving. So what do you do? A couple things. One is do some charitable planning by bunching charitable deductions in any given year. So rather than give $10,000 in 2018 and $10,019, give $20,000 in 2018. Now you've taken that $20,000 gift, added it to your $10,000 of real estate taxes, you're at $30,000 of deduction. And you've achieved the ability now to get the power of that. And then the following year, if you don't give the $10,000 because you in effect prepaid the charitable gift, you'll get a continuing $24,000 deduction from standard deduction. So it's a very powerful tool to just simple planning for clients that are falling into this area, which are many of our clients, even some of our very high wealth taxpayers. They didn't have a lot of itemized deductions on their return. I wish they were more charitably inclined and didn't have this issue, but that's a different conversation. But that's that's one very simple plan. The other is in this bunching. Some people say, well, I'm not sure I want to give $20,000 today to organizations that I like to give $5,000 a year to. How can I do that? And there's a vehicle called donor advised funds. Donor advised funds are public charities under the tax law, and they are dollars that you contribute into a fund. You get an immediate charitable deduction, but then the fund takes these dollars, holds them for the benefit of ultimate charitable recipients, and you advise. That's an important phrase here. You advise that fund how you would like the monies held in that fund to be distributed amongst charitable organizations. We saw a lot of donor advised fund creation again in 2018 as a result of this new law. Rachel's in this world, and I know where you are, you actually run a donor advised fund. Did you see an uptick? Yeah, for sure. Now, the donor advised funds are, it's basically like having a private foundation without the cost of having a private foundation. You're able, the money accumulates, it can be invested during the accumulation period, and then it can be doled out to charities over time as you see fit. So you don't have to do this planning just for my example of the $10,000. You could put $1 million into a donor advised fund today, get a current charitable deduction for that, and then use that fund to grow and allocate to charitable organizations over time. And there's no, I believe there's no current minimum annual distribution requirement from the donor advised fund. But private foundations, there are requirements, 5% requirement that you have to distribute a certain amount. The donor advised funds currently don't have that. There's been a lot of discussion about that. And I wouldn't be surprised someday if legislation doesn't get enacted to try to make it more in line with the private foundations so that the monies in these funds are at least to some part being used annually to benefit charitable organizations. For clients that are not able to itemize deductions, there's always been, for many years now in the law, a provision for clients that are over age 70 and a half that are taking required minimum distributions from their IRAs. They've been able to make up to $100,000 of donations directly from their IRA to a charitable organization. The consequence of that is that typically if you take a distribution from your IRA, it's taxable. And then so if you took $100,000 from your IRA and then you gave $100,000 to charity, you would, under the old rules, you pick up $100,000 of income, and then you take a deduction for $100,000. So it sounds like a wash, but because there's under the old laws, there are some limitations and possible threshold reductions on deductions. It may not be exactly a wash. You may actually have cost yourself a little bit. So the law now has allowed for a while and continues to allow individuals who are eligible to have that $100,000 or less go directly to a charity, right out of the IRA. You don't take it yourself, it goes right to the IRA, from the IRA to the charity. That way, the individual does not have to report the $100,000 as income, nor do you deduct the $100,000 as a charitable donation, but you've effectively gotten that money out of your IRA tax-free to benefit the charity. It's a very powerful tool. Many of our clients utilize this on an annual basis, and especially for those that may not be not be itemizing in the future and want to maximize their $24,000 standard deduction. They could take $10,000 a year that they would otherwise have given out of their personal assets and use their IRA to get that $10,000 gift to the charity and still preserve the $24,000 deduction plus not pay tax on the IRA.
Scott,
yeah.
Can I just say, you can't take the $100,000 from your IRA and put it into a donor advised fund. That's a really important point. It has to go directly to the charity. So you can't start to create that private foundation for your family by transferring IRA assets to a donor advised fund.
And excellent. Yes, donor advised fund and private foundation also are not eligible recipients of this. So, the other more complicated topics in charitable giving that clients, typically more high net worth clients, do are utilizing vehicles like charitable remainder trust and charitable lead trust, which are vehicles where in a charitable remainder trust you put and you make a gift of an asset into a vehicle, a trust. You retain an annuity stream from that trust for a period of time, and at the end of the term, the asset goes to charity. What's left in the trust. It's sort of that same GRAT concept, except the annuity that you take back is not prescribed under the IRS rules. You can determine how you want the annuity to be structured in many ways. It affects how much of your charitable deduction that you get ultimately, and then gets complicated. But it's a great vehicle to, if you have a highly appreciated asset, because you're allowed to deduct gifts. Back to my Apple stock, you can give $1,000 of Apple stock to a charity today and get a $1,000 deduction. Even though you have $900 of embedded gain in that stock, you don't ever have to pay income tax. You could put that $1,000 of that Apple stock into a charitable remainder trust. The trust can turn around and sell the stock. And because it's a charitable trust, there's no income tax on that gain. And then you only pay tax as you get your annuity out every year from this charitable remainder trust over what could be a fairly long period of time. In the meantime, that $1,000 that you sold the Apple stock can be invested through investment vehicles and can continue to grow. It's a great way to diversify portfolios, but again, you have to be charitably inclined because at the end of the day, what's left over is not yours. A charitable lead trust is sort of the opposite type of vehicle. You put money, you put something into this trust, the charity gets a stream of income over a period of time, and at the end of the day, what's left over goes back to your estate or your heirs, however the trust is set up. They are more complicated because there's two different kinds of charitable lead trust vehicles that depending on your circumstances and whether you're trying to achieve a current income tax deduction for a charity or not, they can be structured in different ways. I already spoke about using appreciated securities as a powerful tool. Be aware when you give under the tax law, both before and now, your charitable deductions are limited to a percentage of your income, your adjusted gross income. If you give cash to a public charity, you can deduct under the new law up to 60% of your adjusted gross income. So if you have $1 million of income, you could give $600,000 of cash away, get a full deduction. The old law was 50%, and it gets very convoluted how that 50 and 60% play in, depending on how much you give and in what capacity. However, if you give appreciated stock to a public charity, you can only deduct 30% of your adjusted gross income. So in my $1 million example, you could only give up to $300,000 of stock value to get a current deduction. If you give more away than you're allowed to, you don't lose the benefit, it just gets carried over for a series of years and then ultimately expires. So, for clients that are really charitably inclined and giving away a lot, you have to manage this to try and maximize the deduction. If you use your private foundation as a vehicle to make gifts, if you give cash, that's subject to a 30% limitation, just like appreciated stock to a public charity. And if you give appreciated stock to a private foundation, you're subject to a 20% limitation of deduction. So you have to do all this planning. If you give gifts of assets that are worth more than $5,000, public stock doesn't come into play in this. There's an exemption. But if you give assets worth art, for instance, to a charity, you have to have an appraisal. There's a series of appraisal requirements and disclosures on the tax return. The IRS has been enforcing these rules and have actually won cases where donors gave significant assets of value and did not follow the appraisal requirements and lost the benefit of their charitable deduction. So clients considering giving assets, atypical type assets, real estate to a charity, art, there's some very important rules. I'm going to skip, and if you want to talk about it afterwards, just let me know. 199A, because this is a 5-day topic. But the thing you need to know about this is federal tax rates for corporations dropped last year to 21% from 35%. Most companies operating in America don't operate as tax-paying corporations. Most of them are partnerships, LLCs, subchapter S corporations, which are entities that elect to be taxed at the individual level. So Congress said we don't want to penalize those entities that are structured in a different way, and they created the most complicated tax provision I've dealt with in my pretty close to my career, that basically allows taxpayers to get a deduction against their income for up to 20% of the income generated from these businesses. Effectively, instead of paying tax on 100% of your income, you're paying tax on 80% of your income, and effectively that drives your tax rate, if you're in the top bracket, of 37% down to 29.6%. So it doesn't get it down to the 21% that corporations are paying, but down to 29.6%. The law is incredibly complex. It has not achieved the goals that it supposedly set out to do. We've had surprise after surprise after surprise as we've analyzed our clients. Mitch actually spearheaded a team here At our firm, we had to first look at every single client's situation separate and apart because everybody's situation differs as the way the new law gets interpreted.
So can I just make a quick comment?
Very quick, yes.
Okay. The comment is that with when you talked about how the states were trying to figure out a way to still be able to get the state taxes as a deduction, and they came up with this idea. And then the 199A, lawyers, because their service businesses are really limited in what they can do, came up with their idea about moving some of their assets into a rental and over here, and we'll get it over here, we'll get this deduction. You have to keep in mind the Treasury and the IRS are reading the same planning articles and newspaper articles, and that's basically why they come out and they just shut down all of these strategies. So, you know, it may sound good, but just keep in mind that these strategies may not last very long.
And to be fair to the IRS, just as all this, I will say, you know, Congress passes our laws, and it's not the IRS that passes our laws. The IRS has to manage the laws that they're dealt with, and I just want to do a shout out to the IRS for this past year because they've been under the gun. It's been a very trying time. Getting forms revised, understanding how to roll all this out, and to interpret these laws that in many cases are almost uninterpretable the way they were written. Some of these provisions were very hastily to keep families from giving assets to lower tax rate children and having them pay taxes at 0 or very low tax rates and save the income tax. It was a very messy tax calculation, to say the least, and it basically required. We could never finish a child's tax return until the parents' tax returns were done because we couldn't calculate the kid's tax until you knew the parents' tax laws. The new law simplified it by basically eliminating the tax calculations being one tied into the parent's income, and now ties the kids' tax rates to trust tax rates. So as Jeff mentioned, trust tax rates are really compressed, and you pay tax quickly at a high rate. The new kiddie tax rules work the same way. The kids' income gets taxed at these trust tax rates. So we're very happy about this, but it's actually created some pretty significant tax increases for many of our families where the parents weren't in the top tax bracket, where some were in much lower brackets because most of their income was generated by capital gains, which are taxed at a 20% rate. And now the kids' tax rates went from 20% to 37% on income. So there's been some surprises. Roth IRAs. I just want to throw it out to always remember, if you have a child who you could employ in your business for a few $1,000s a year, and they actually do something, and they're not a 6-month-old. I'm talking about someone who can actually do something. You could use that as the opportunity to also make a contribution to a Roth IRA for that child up to that level of income. So if you have a kid who gets $5,000 of income because they're coming in on weekends and helping you actually doing things, you can make a $5,000 contribution to a Roth IRA, and that, as you know, Roth IRAs grow tax-free and come out tax-free. So it's a very powerful thing. So it's a nice gifting opportunity for those clients so inclined. I already talked about the qualified small business stock when I was talking about the qualified opportunity zones. We've learned in this new tax law to expect the unexpected. Nothing has been intuitive as we've gone through tax returns this year. So it's really important when you're doing tax planning with your clients that you understand that what you think the ramification of a decision is going to be may not in fact be the ramification of the decision, and you spend some time looking at it or drilling down to see what it really means. I haven't talked today about, this is not a seminar on state taxation, but state taxation has continued to grow in impact in our world. There was a big Supreme Court case that came out earlier this year, the Wayfair, or was that last year, I guess? The Wayfair decision was a basically a landmark case that overruled prior precedent and now allows states to collect state sales tax on sales in that state from entities, sellers that in the past never really had a nexus to that state other than selling assets into the state. Wayfair expanded that rule. Now many states have followed suit of South Dakota, which was the test case in Wayfair, and passed laws that say if you are selling a certain number of items into a state, or you've exceeded a threshold of amount of sales in that state, you are now subject to sales tax in that state. There's going to be a move towards trying to impose similar type rules in the income tax area, but that's yet to be decided how that's all going to play out. But Wayfair was a real landmark decision, and it affects internet sellers in particular dramatically, who in the past were charging sales tax and sales, and it's all viewed as a competitive disadvantage. And then the Supreme Court spent a lot of time talking about that in their decision. Pennsylvania just recently passed a law adopting some of this Wayfair stuff and utilizing similar levels that the Supreme Court found to be constitutionally acceptable in their decision. The last thing is that on June 28th, just last week, Pennsylvania passed a new budget bill, and they extended the benefit of these QOZ rules I talked about, which Pennsylvania did not recognize in 2018. Starting in 2020, Pennsylvania is going to allow taxpayers to avail themselves of the benefits of the QOZs, which gives you an extra 3.07% benefit on top of the benefits you get from them before. They also made an inheritance tax change that permits transfers of property to children under 21 and younger without an inheritance tax in Pennsylvania. Currently, if you transfer to a spouse, it's tax-free, but if you transfer to a lineal descendant, there's a rate, I think, of 4.5%. For basically 21 years and under, you can transfer this now. Again, I think this isn't effective until 2020. It's not effective currently. And the last item I wanted to mention is state taxation of trusts is also a very complicated area. Many states tax trusts based on where the grantor, the settler of the trust, lived or was located when this trust was created. Many states tax trusts where the trustees are located. Some look at combinations of where beneficiaries are, where trustees are, where the settlers are. North Carolina had a law that basically said we're going to tax any trust in which there's a beneficiary who lives in North Carolina, regardless of whether that beneficiary is eligible to receive any benefit from the trust currently. And that went to the Supreme Court. The Supreme Court found that North Carolina exceeded their constitutional reach, and in that situation invalidated their law of taxation. I'm not sure how it's all going to play out. I think in many other states, this case is pretty narrow, and very few states tried to do what North Carolina did and basically reach beyond their borders to create taxation. But it's to be determined. I'd like to open up to any questions, comments, and thank you all for joining us. We are on time. Thank you all so much, and thanks for joining us today. And follow up with Jeff, myself, or any of us in the team here from Isdaner if you have any questions. Thank you. And we can stay around for a few minutes if you have any particular questions you want to talk about.